So should we get the show on the road?
Let's do it.
All right. Well, just quick introductions. I'm Scott Anderson. I'm the founder of Cash Cow Farmer Financial Software. I farm in northeastern South Dakota, close to Aberdeen, South Dakota, about 7,500 acres of corn and soybeans, and formerly worked investment banking in New York City. Was in New York for 2 years, and when I came back, I realized after the run-up of the bull market, there was a real opportunity in farm management improvement. So started the software company, and then recently partnered with Randy Martinson of Martinson Ag to offer grain marketing support for farmers, so that, it seems to be one of the biggest challenges that people face day to day is trying to figure out how to navigate forward contract and really have a good solid marketing plan and make sure that they're selling their crops at the seasonal best prices. And so, yeah, go ahead and introduce yourself, Randy.
Okay, I'm Randy Martinson. I'm with Martinson Ag Risk Management, obviously. We just started, actually, I've been in this business for about 22 years. Did it with another firm, and in beginning of this year, 3 other partners and I started this company, where our focus basically is hedging, not just on the futures and options and advice for farmers, but also then doing crop insurance besides. So we're kind of the risk management package, where we help market the grain and we help do the insurance. We tie the two together so that we can actually do it without bringing any more risk onto the farmer. So that's I do farm a little bit too. I do run cattle with my brother down in southeast North Dakota is where I'm from. And we've been doing that for about 15 years. So.
Yeah, and in regard to commodities that we work with on a regular basis, it's corn, soybeans, wheat, and then given that we've got experience with some of the specialties, it's sunflower, canola. What else, Randy?
Dry beans, durum. Work with barley, edible beans, rye. That's the big ones.
Yeah. But the thing with grain marketing is that everybody's got a different situation. We all have a different insurance program. Some people can store a lot of grain. Some people can't store any grain. So everybody really has a different situation that they're in. And a cookie cutter grain marketing plan doesn't work great for everybody. And it doesn't get followed very well if it doesn't take in your personal economics, your personal cash flow needs and situations. So we try and tailor it. And today we're going to be talking about 3 parts of the plan, the grain marketing plan, and how they play a role in there. First being insurance, followed by price targets, and then quantifying sales. Some people, when we talk insurance plans and we're asking people when we're talking grain marketing plans and we ask people what they're doing right now, people will say, well, how do you have a plan and how do you market what you aren't sure you're going to grow? Which is a great question, but at the same time, there's your insurance and there's a handful of things that play into a big part into how you grain market and forward contract, especially if you haven't even started planting and prices are good and you want to hedge some risk, or if you just started planting and you want to take some risk off the table because the market's rallying due to planting challenges or something like that. So there is a lot to it, and we're going to try and simplify things and just give a few pointers with all 3 of those: insurance, price targets, and then quantifying your sales. And hopefully that'll help people have a better plan. So why don't we just get started with insurance? And again, marketing's not about hitting home runs with your farm. If you're going for home runs, you're going to strike out a lot, and you can only take so many strikeouts in a row before we lose the game. And it's about getting base hits, trying to be in the top 50% or the top 30% of the marketing year average. And you're going to do good if you're up there, making incremental sales and stuff like that. So let's start with insurance, and I'll make a few notes on the board just so people have something to follow along with. So insurance, there's basically 3 main points about insurance and how they impact your grain marketing. And the first thing, is that legible?
Maybe a little bigger would help. You can see it, but some of us with older eyes.
I'll zoom in a little bit here. We got pull the computer forward and we zoomed in.
There you go.
So insurance, one of the main things is what's your guarantee level that you bought. And Randy, being that you sell insurance, let's just throw a scenario out there. So let's say you've got 100 bushel APH, just for easy math, and 1,000 acres.
We'll be talking corn here, I assume.
I wish it was soybean APH.
Soybeans, right? So
100 bushel APH. APH is one of your important factors. The second thing is your percentage guarantee level that you bought. So let's say you bought 80% of that. So that's number 2. You bought 80%. So per acre, you can have 80 bushels marketed before you actually know what you're going to produce, because your insurance is going to protect you on that. And do you want to elaborate a little bit on that, Randy?
I do. I think, yeah. The other thing you have to look at is, there's a couple different types of insurance that's offered too. There's the revenue, and then there's just the yield, which, the YP and then RP. When you look at buying the yield protection, even if it's at 80%, you're limited on being able to price a lot because you don't have that price guarantee. You don't have the revenue guarantee. Whereas when you buy revenue protection and at the 80%, now you do have 80% not just guaranteed for bushels, but you have the revenue locked in, which is the prices are set in the spring. The first round of it is set in the spring. So 80% of your revenue will be guaranteed on your production by buying the RP coverage.
So there's a fair price difference in the premium between YP and RP, right?
Yes, there is. And really the difference that comes into it is the RP, because it's got the revenue side into it, costs a little bit more, whereas the YP, which is just the yield side, is a little bit cheaper and a little less expensive.
So in regard to your grain marketing plan, one will guarantee your yield, one will guarantee your revenue. What is going to give you greater flexibility in regard to marketing, would you say?
Oh, the RP by far, because that gives you the opportunity to be able to go out and price with comfort. Because if the price goes up, you get the higher of the two prices, and that's the beauty of with doing the RP insurance. When you take the harvest price option, you get the higher of the two prices. So if the spring price, if the fall price is higher than the spring price, the fall price is what gets used as figuring what your guarantees are. So that's the benefit of buying the RP insurance. So it gives you that peace of mind that you can price ahead, but you can still, if you have a problem, still get the higher price as far as if there's a claim or if there's a production issue.
If anybody has any questions, go ahead and type it into the Facebook comment area below. It looks like people are able to hear and everything. I'll try and keep on. I know there's a little bit delay between when Randy and I are talking and you guys are actually hearing it by the time it goes through all the system and whatnot. So if anybody has a question, I'll do my best to answer it right away as soon as I notice it. So go ahead and type questions in is whenever you have them, if something's unclear and you want further clarification. So this means basically that we can, if you have an RP plan, you're pretty safe forward contracting up to 80 bushels per acre on that in the cash markets, right, Randy?
That is correct.
So what do you recommend with the last, the third point is basically that last 20% of your production?
And that's where things get to be a little bit sticky, because if you're looking at 100 APH on your corn, that you need to figure out another method to use that doesn't bring risk to your operation. So you don't want it to be vulnerable in the cash market, basically. So you want to use another tool. I like using options, buying put options to protect it. If we've got a good spike up in the market, that last 20% is nice to use options. That way you're locking in a floor, but yet you're keeping your upside open, and you're not obligated to have to deliver that at harvest time or at any time in the cash side of the market. So it gives you an opportunity to price it, but yet have opportunities for upward movement in the market as well.
Let's assume that you marketed 80% of your production, or 80, in this example, 80 bushel the acre, and you only got 60 bushel the acre due to weather. How would that play out with your insurance? Because let's say you wouldn't be able to fill your contracts at the co-op. How would that play out with insurance, would you say?
You know, for the most part, what happens in a case like that is you deliver your 60 bushels, you get paid by the elevator for the 60 bushels. You would then have to somehow come up with 20 bushels to fill your contract to the elevator. And how you would have to do that or buy out of that contract would be on the claim side from your insurance. So you put the claim in, you harvested 60, they pay you for the 20 bushels at the price that's determined in whatever contract you have from the elevator. You would then, once you get the claim situated with the elevator or with the insurance company, you get paid your 20 bushels times whatever the price is for the higher of the two, the fall or the spring. Say the fall price goes up because you're looking at a production problem, price goes up 50 cents. Now instead of $3, you're going to get $3.50 on those 20 bushels. That's going to give you the money to pay off the elevator for the bushels that you've sold there. And then the elevator does pay you for that because you've collected that money as well. So
just had a question about the definition of APH, Randy. Actual production
history. Yep.
Yep.
So it's the actual, APH is the actual production history for that unit, and a unit basically is the acres in a quarter section that you have for that crop.
Okay, so that's generally taken over 10 years of that production of that specific crop, right?
Correct. Yeah, they take you know, 4 years is what you need to have for a database. I mean, you know, as you new farmers start, you only have, you know, you get years as you go, but then it's what's called T yields get plugged in. You have to have 4 years for a database. And then it's basically is a 10-year running average of once you get the history and you start building it, they use it 10 years to figure out what your yield's going to be.
Gotcha. So just in summary, the APH, extremely important to know at least the average for that crop. And you can ask your agent. You don't have to sit down and calculate all your APHs. That's why you pay insurance agents like Randy those big bucks so that they can do a little number crunching, right?
That's right.
You could always ask your insurance agent, when you buy your policy, what's my guaranteed bushels? And that they'll tell you, okay, they'll take all your APHs for all your field, multiply it by whatever percentage you bought. That's why it's also good to buy 80% rather than 60%, you know, for example, because you're going to be able to go a lot further in the cash markets. And the nice thing about the cash market is you don't have to put up margin. You know, if you're doing everything in the futures market, you have to put up a lot of margin. And if we're looking at a year like, you know, 2012, where you're happy selling at 550 and all of a sudden the market goes to 8, that's a lot of futures margin that you got to come up with, and that can really suck the cash coffers pretty dry. And so, you know, just be wary of that. I always buy 80% insurance generally. In my area, it makes a lot of sense. Plus, it gives me very, very good flexibility on my marketing as far as what I can do with cash contracts. So that's what I like about that. And then also with whatever you're not marketed, managing the price risk with options makes a lot of sense. So if you have questions,
yeah, especially in years when you have a good push in the market early and you want to take advantage of those higher prices, which traditionally, you know, when you look at a seasonal movement of a market, you're going to see your higher prices in the spring when the uncertainty's there. And then once the crop gets planted and a little bit more is known as far as production and a little bit of each day that the risk declines as far as issues with crop production, then markets have a tendency to drift as well.
Yeah, so let me just refresh the page and make sure there's no questions on here we didn't answer. Looks like we got all the questions answered. So let's jump next to price targets. Now, this is something that's quite a bit more technical and can take a lot of time spent in the library or a lot of money making mistakes in order to figure out. And in regard to price targets, it's basically trying to determine at what point you want to sell your grain. And we'll break it down in increments next when we go to quantifying the sales amounts. But price targets, first and foremost, you really want to figure out your production costs and make sure that you're not locking yourself in for losses. And there's a handful of ways to do production costs. You can do pencil and paper. Excel spreadsheets is pretty popular. There's some farm management software programs out there. Cash Cow Farmer, we have a free 30-day trial for people who are on the call here. They can check that out. And then, we'll include a follow-up email to this with a little demo on how that works. But really, you got to know what you got into the crop before you really want to make any sales, or at least have a good projection. If you got crop growing in the field, you're never sure what your yield's going to be because, hail could come or it could forget to rain for a while or what have you. But it's really important to know a really good idea, have a really good idea of what your production break even is. Wouldn't you say, Randy?
Yes, it's very important. I mean, no matter how you look at it, in a year that the markets are declining, you want to still know where you need to be at to get all your expenses paid. And at worst case scenario, you want to try to minimize as much loss as you can. It also will help you give you an idea of maybe some cost areas or some areas where you could maybe trim some costs once you figure out where your costs of production are. If they're a little bit too high in some areas, it gives you an idea of what you need to trim.
Exactly. And you can always, like with our software program, you can easily change your rent number around and say, okay, if I'm paying 150 versus, 175, how is that going to impact 168 bushel yield or something like that? It's quick and easy math. So yeah, for price targets, number one, I mean, you got to know your cost of production. Everybody that's gone to ag school, gone to school for, business in regard to farming and stuff like that, ag business, that's what their number one thing is. They teach in calculate your cost of production. And then when everybody graduates, because they don't have to get a grade on it now, they forget about that part. But really, it's turned my business around, my farm. I mean, we've been profitable. We've never had a down year. We've never lost money on the farm, even though things have been real tough and real tight, because we've really had our production costs dialed in. We've dropped rental land that didn't make sense. We turned some stuff into CRP because it didn't make economic sense. So number one, cost of production is what you got to know. The second thing in regard to price targets, which Randy is a lot more experienced than I am on this, it's technical analysis. And this is basically looking at price history and, charting, things like that. Our technical analysis, trying to find shapes in the charts, looking at points of resistance, points of support, and trying to determine, if we break this support point, where's the next point where we might stop dropping, or if we're in a rising market like we had, this last June and a year ago, July, trying to figure out, okay, is it going to go to $5 or is $4.50 the end of the road here? How do you know? And the best way to figure out in regard when the market may be running out of steam is technical analysis. And we got a couple of really good book recommendations. Market Wizards is probably one of the best books I've ever read on trading and technical analysis. And then Randy recommended The Way of the Turtle, which is one of the students of one of the guys interviewed in Market Wizards. Very, very good. Very technical. Very technical. You're going to need a dictionary, an Investopedia dictionary with this thing. And then I really like Hot Commodities by Jim Rogers, one of the most famous commodities traders in the world. He used to trade with George Soros and the Quantum Fund. Very, very interesting book. And he talks a lot about all the different futures markets and stuff like that. So, Randy, in regard to technical analysis, do you want to add a few points on that?
Yeah, some things to pay attention to is when you're looking at technical analysis, especially when you're looking at levels to do pricing at, and when you're looking at your farm operation of where you want to look at having your pricing targets. A daily chart basically brings in too much emotion. I mean, it's the day-to-day activity of the market, and it's bringing in all of the different news items, those that are relevant and those that are irrelevant, that helps drive a market. And in the short term, which is what a daily chart is, it's pretty inefficient to watch because it's just too much raw emotion. It's basically following the herd mentality. When I like to do, for the most part, doing the price targets, I like looking at weekly charts, which then gives you a little bit broader spectrum to look at too. A daily chart will go about a year, maybe to 18 months, where you're looking at a weekly chart that'll go 3 to 5 years. And then even one that's even better is monthly charts, which gives you a look of about, from anywhere from 10 to 25 years. Now, you have to be careful when you're looking at monthly charts because over time, our farm programs have changed, our crop makeup has changed. We're a lot more corn and soybean intensive now than we used to be. We used to have a lot more wheat acres. So you have to be careful of not going too far back in time so that you take some of the ethanol is a perfect example. That when ethanol came into play in 2008, it changed the makeup of corn. Well, you can't really go back too much farther than 2008 to look at it because we changed the dynamics of the corn market in that year. So look at using the right amount of time as far as the charts so you can get a good look at history so you can see the actual potential of a market.
Yeah, that's a great introduction to the next thing. When you brought up ethanol, ethanol was a fundamental change in the economics behind supply and demand corn. So right now, if fundamental analysis is mostly supply and demand, which is the USDA reports really, that's why USDA reports have such a dramatic impact, because it tells what's happening in supply and demand economics. And if supply is going up like it has the last 3 years, we're looking at record production in corn and beans. And I mean, that's the problem with wheat right now. I mean, wheat's a great commodity, but there's just too dang much of it. And the world's overproduced for what it can consume. So the supply has taken over demand. And when you have so much of something, it's no longer a great thing. If everybody drove a Ferrari, if Ferrari would be the same value as a Ford Escort or something like that, or Honda. So really, it's that scarcity that drives up the price. And when things happen in the supply chain, such as this spring when we had the weather rally, and last year when we had the weather rally in July, I mean, that was impacting the supply. And that's the fundamental analysis. And when Randy brought up ethanol, I mean, when you basically say, hey, we're gonna take half of the corn away from the market, you have a huge impact in price. So yeah, that's part of the fundamental analysis. Some of the other things, and Randy, you've pointed out a lot of these things and taught me a lot about this, but looking at like feed use and all these other things, for example, if the cattle numbers are down, the feed use is going to be down, and you can kind of tie together these dots of all these fundamental things happening in supply and demand and figure out, where the trend is going to be down the road. So you want to add a little bit to that fundamental analysis?
Yeah, I mean, that's a good point. I mean, you have to pay attention to what the biggest consumer of the crop is. When you look at wheat, our biggest consumer of wheat is exports. If you don't have a cheaper dollar and you can't compete in the world market, wheat's going to suffer a little bit, and you're going to build stocks. That's basically what's been happening in the last couple of years with wheat. Our exports haven't been very good, and we've been building stocks. Corn, your two biggest demand sources, ethanol and feed demand in the U.S. That's right there is the two biggest sources, is where they're both about 5 billion bushels each. The others comes in, the exports are important, but not as important. And then you've got domestic use with industrial. The other part, when you look at soybeans, your biggest are crush and exports. They battle between each other, and that's the two largest demand areas. So as far as wheat and soybeans, we say we have to export somewhere between 30 to 50% of what we produce. And for corn, it's not as important. So when you look at the markets, that's, if you got a bigger production in South America with soybeans, that's going to take a lot of our export demand away, and we have to depend more on the crush market. And so that's the fundamentals that you really need to pay attention to when you look at those three crops.
Yeah, we talk mostly about corn, soybeans, and wheat because that covers a big portion of the market. If somebody wants to talk about something else, we'll do our best to cover that, given that we have experience. I mean, if we're talking pecans, we might not be able to relate much to that because it's mostly a California crop, but cattle and stuff like that. I mean, Randy's been in cattle for a long, long time. So if you have any specific crops you want us just to break down real quick or anything in regard to that, go ahead and type a comment in and we'll do our best to give you a solid answer. So that kind of wraps up price targets. It's one of the hardest things about grain marketing is determining price targets. But again, know your cost of production. And when the price is above your cost of production, really look at trying to figure out where the strength and resistance points are. And I mean, with the service that we offer in marketing, I mean, Randy will break down the markets every day and send out a daily email so like what's happening. But more importantly, when there's an opportunity that we hit one of those long-term, support or resistance lines, and the risk of going down is a lot higher than the risk of going up, we're recommending sales, and Randy's really good at doing that. And honestly, I wouldn't be farming anymore if it wasn't for Randy's sales expertise and working with me on my farm for the past 4 or 5 years. So that's been instrumental, is having an expert, whether it's us or whether it's somebody. Just get an expert. Working with your local co-op is good and valuable. I mean, they're not going to purposely steer you wrong, but I mean, having an independent party advise you on what to do with your grain, when to price grain, stuff like that is extremely important. So anything you want to add to that, Randy?
No, I think you're right. I mean, that's the important thing, is having an unbiased source to get information from and to bounce things off of, if nothing else. It's important to have, you don't want to have too many opinions coming in, and you don't want too contrarian of opinions either, because one that's extremely bearish all the time and one that's extremely bullish all the time, because then you're going to get conflicted too. But it's important that you do have somebody who's watching this every day, somebody who's paying attention to the, like right now, some of the big things that we're paying attention to is what's going on in South America with planting. We're also watching Australia with their wheat production. We're also watching Canada with what's going on with their wheat. That's all of the things that are coming in to drive it, and how interconnected all these crops are. Wheat is connected to corn because of their needing to battle for the feed ration right now, which is also connected to DDGs from ethanol with the soybean meal production. So all this stuff is tied together, and knowing how they're tied and what influences they have is pretty important.
All right. Well, it doesn't look like there's any questions that we haven't answered so far on price targets. But moving on, we've got quantifying the sales. So how do you quantify something you're not sure you're going to grow? So we talked about the insurance side of things and picking price targets. Now let's talk about breaking that down into marketable units, and then how much you should be selling depending on where we're at in the season, especially in the cash markets. So the next topic is quantifying those sales. First, breaking it down. Generally, we break it down into 4 or 5 different bundles of sales. And so you want to break that down, Randy, the group in the sales into 4 or 5 different units, and what makes sense on doing that?
Sure. What we try to do is break it down. I mean, of course, the more opportunities you have in selling in a market, the better off your average price is going to be. And the idea is to try to get the first sales as the market is climbing. And there's different timings of when you want to make sure that you have the sales done. And then once you've reached the peak of the market and you started coming back down on the downside, you want to pick it up, and then that's when you want to try to finish your sales. What I like to do is try to have somewhere in the area of a third of the crop priced by the time you're planting or by the time the crop is emerged. So we're looking at trying to do a 10% sale somewhere between now, and you like to use about an 18-month window. So sometime between now and the time that we get into the March timeframe, it would be nice to have about a 10% price of the next year's crop.
So we kind of broke it down into a 10% sale, 15% sale, another 15% sale. So 3 sales, you're 50% sold.
And we like to try to have that somewhere around the time frame that you're going to be looking at the crop, getting into that for corn, the July 1st time frame, because by then corn is usually traditionally made by the time you get to the July time area. So our idea is to try to have 50% price by that time frame. Normally you can get a little bit of a spike in the late July, early August timeframe, and that's where you might want to do a little bit of a catch-up sale. For soybeans, we want to have that 50% priced by the time we get into close to that August. Beans are made in August, basically. So you watch how the crop development stages go, and by the time you've got the crop planted and you started, it's a third, and by the time, and this kind of goes with the cash side of things. Once you get through that critical time frame, then you can get to be up to your insurance guarantee for on the cash side, which then would take you, like in Scott's example, up to 80% priced. And then the last 20, we would look at doing sometime later, or when we think it's peaked, and then look at doing that as far as in the options market.
So we got 5 sales here, 10, 15, 15, and then 30 for the 4th one, and then 20% for the 5th sale. But the last half happening generally after the 4th of July in corn, and usually in August for the soybeans, just making sure that you've got the crop. Of course, there's always exceptions, depending on where we're at. Like, let's say price is greater than your 5-year average. Well, we may want to get a lot more aggressive early on. I mean, it's different every year, and it's different depending on your cash flow and how much storage space you have on your farm and whatnot, because it's going to change the economics of your carrying costs. So, remember, grain bins are not to make up for marketing mistakes. It's to take advantage of better basis in the after harvest, because harvest is obviously the worst basis, because they're just getting, the elevators and co-ops are getting hammered. And in order to store that grain in a bin, depending on your economics, of course, you generally want another 25 cents out of that market. So that basis has to come down by 25 cents in order to make, sitting on that grain make sense. But yeah, in regard to quantifying sales, you never want to make, less than, let's say, 4 sales, because if you're pyramiding up and locking in profit, you're taking that risk off the table. And you can always re-own with an option. You can buy cheap options that are way out of the money if you want to take some of the upside. There's always a handful of stuff. We're going to do another one of these going over options and futures contracts, and I'll be sharing my computer screen doing that, and we'll be just looking at how options are priced, what type of options make sense, some option strategies and stuff like that. We'll do that further down the road. But yeah, for now, quantifying the sales, that's basically it. It's not only the amount of grain, it's also the time in where we're at in the growing season.
Exactly. And the first sales, which we hope are going to be our lowest sales, we're trying to do those at the elevators and hedge to arrive, so that they carry the risk of the margin calls and all. If you're have an elevator that you're comfortable with, that's where we're going to be looking at doing those first sales at, because hopefully they are the lowest prices that we're selling at, and they're also going to be early enough where then they can carry the risk or the margin so that it doesn't hurt your cash flow for your growing season, to make the margin calls and take money away from other things that are going to be more important.
Yeah. Randy, what would you say would be a good percentage over the farmer's break even in order to start locking in sales? I mean, I usually shoot like if you take a 5-year average, if you can get 25% profit margin, you're looking like pretty productive.
Yeah. I was going to say 25.
What's that?
I was going to say about 25% margin. Yeah.
Yeah. So if your costs of production are $1 million and you got the opportunity to lock in, 1.25 million in sales, you'd be kind of foolish not to lock that in. Of course, you could always re-own that grain, with options and futures, of course, but then you not only have to make a good buy, you got to make a good sale when you own futures. You gotta then you gotta sell it again, which it's hard for us to sell grain, being that we're farmers, whether it's on paper or in real life. It's tough for us to sell. And the last thing you want to do if you are using futures and options contracts is sell short the futures and not offset that with the grain sale, or not offset you don't want to double your losses. And that's how farmers go broke messing with futures and options, is they double their losses rather than offset the price volatility.
We'd like to stay away from Texas hedges. You want to keep it hedging and stay with as close to a hedge as possible, so that way the risk is transferred. And that's actually the definition of a hedge, is transferring the risk off of you and putting it onto somebody else for the growing season. And there's ways that you can do that, and whether it be using futures or options, and everybody's risk tolerance is different. Some like to strictly do the cash marketing, and we've got quite a few guys that just like to do cash. And that limits you a little bit on your ability to market, but there is a way to do it as far as putting together, once you know your cost of production, you look at the timings of the market and look at the seasonals, you start using those in your benefit.
Yeah. I mean, just farmer to farmer, we're so busy running our operation and making sure that we're going to have a crop that it's just tough to put all this stuff down. And I know the bankers have been helpful, making sure that we got plans and stuff like that. But having somebody that spends all day, every day in the markets and watching things on your team is essential. It's essential. No Fortune 500 company does the company not have a CEO, a CFO, a CMO, a COO. There's always people that are responsible for certain extremely important parts of the business. And if you break a farming operation down, you're going to have the operations manager, you're going to have a financial manager, you're going to have a marketing manager. And, those are the 3 key spots for farming, is making sure that the leverage is at an acceptable level with the financial side, making sure the operation is running smoothly and efficiently. All the machinery is at capacity as much as possible. And then of course the marketing. And, we do these free webinars because we just want to make sure that, there are people out there that have really good track records, really good experience. Randy's one of them. From a farmer's perspective, I worked with Randy for quite a few years and I'm really happy with that. So, there's a few buttons at the bottom of this. I'm going to keep checking for any more questions. I've got everything so far. Type a question in as soon as you have one, and I'll get it answered. But below the video, there's a free 30-day trial of the management software, and then a free strategy session with one of our analysts. And it's always good to check and see if what you're doing makes sense. And if you don't have a strategy, then we should definitely set up a time to visit about that. And at least, we're more than happy just to give you some good advice and have you do it yourself. I mean, there's, you don't always have to pay for everything, but yeah, we're here to help. And if you have any questions, feel free to reach out. We'll probably update people on the next one that we're going to do in a couple of weeks or so, and appreciate people's time. I'm just going to check one more time for any comments. If you comment later on, I'll do my best to keep an eye on the feed and and get back to you with just a text answer or an email. You can always reply back to the email as well, and one of our team members or myself will get an answer to you. So without further ado, is there anything else you wanted to add, Randy?
No, I think the biggest thing, and just to, and kind of what you've been covering already, and that is, producer's job is to produce a crop and then to sell it. And that's sometimes we lose sight of that. Like you said, grain bins, I love grain bins. I think they work great, especially at harvest time when you want to keep the combines rolling. But I've always said that at some point in time, there should be an automatic auger that turns on and starts unloading it, just so it'll force producers and force you to move that grain at some point. And there are time frames where corn is a market you can put in the bin and store because it's got a carry. Wheat, most of the time, has a carry to a certain point. Beans, you can actually, there's not much of a carry in the bean market usually because they need the product sooner than later, and then you've got South America coming 3 months later. It's cheaper to own beans on paper than it is to own it in the bin. And those are some of the things that we watch and pay attention to. And we help you market your grain to help you give you cash flow to keep operating.
Yeah. Businesses don't go broke because they're not profitable. They go broke because they run out of cash. And with all the Section 179 expenses during the golden years, the cash sitting around is kind of vaporized and turned into steel. So, it's always good to make sure you've got a solid strategy to match your marketing plan should match your cash flow. And if you go to cashcowfarmer.com and you click on the blog, you'll see that I've wrote about that recently and done some podcasts. You can go to your podcast player, whether you're on iTunes or something. I've talked about cash flow and grain marketing and done a lot of grain marketing stuff. So feel free to reach out to those free resources. So, well, we appreciate everybody's time. Sorry we ran over the planned 30 minutes, but hope it was valuable. Thanks for your time, Randy.
Yep. Thank you.